Folks, before we jump in, let me ask you something. Why do you think gold is at an all time high? Why do you think your neighbor, your brother in law, even your dentist can't stop talking about how gold is the only safe haven left? Why do you see TikToks and news headlines shouting gold at $5,000 soon? Is it because gold suddenly became more useful? Does it fuel AI chips, cure disease? Or maybe it just sits there, shiny and heavy as always? In today's video, I'm going to tell you why I believe gold will fall and why millions of people might get caught holding the bag when the music stops. I'm going to show you what nobody on Wall Street, YouTube, or even CNBC will. And I'll share some stories that Wall Street hopes you never hear. So grab a coffee. This could be the most important investing video you watch this year. Let's confirm why you clicked. This is about why gold's price could crash. It's about why even the biggest tech investors, the ones who build trillion-dollar companies, are worried, not bullish, about this gold mania. You're about to get a totally different perspective. Not hype, not gloom and doom, just reality. And I promise you, the story you'll hear today might save you years of regret. Stick with me to the end, because at the end of the video, I'll give you my step-by-step investing checklist for 2026 and beyond. What I'll actually buy and what I'll avoid like the plague. But first, let me open with a story. In the spring of 1999, a friend of mine called me in the middle of the night. He was panicked. His neighbor had bought internet stocks and made a killing. He wanted to know, should he take out a loan, maybe even a second mortgage, and buy Amazon, Yahoo, and a then red-hot startup called Webvan? I told him, don't chase what you don't understand. If you're calling me at midnight, you're feeling FOMO, not conviction. 3 years later, Webvan was bankrupt, Amazon was down 95%, and Yahoo was, well, Yahoo, that friend, he'd lost everything in the dot-com crash. Today, I'm getting those same late-night calls about gold. Friends, colleagues, even a few tech VCs. Some are selling stock options. Some are cashing in their 401ks. Larry, gold is the new safe haven. It has to go higher. What do you think? Folks, when fear replaces logic, it's time to look in the rearview mirror. Let's dive in. Let's be honest. Gold isn't up because suddenly it does something new. Gold is up for one reason. Fear. Fear of inflation, even as inflation rates have cooled. Fear of global crisis, even as companies keep growing. Fear of currency collapse, bank runs, political circus. The headlines scream, central banks are buying gold at record levels. Goldman predicts $5,000 soon. This time is different. Anyone else feel like they've seen this movie before? Let me show you something. 1980. Gold soars to $850 per ounce, about $3,200 today, adjusted for inflation. Everyone's a gold bug. Then it crashes 65%, doesn't recover for decades. 2011, gold hits $1,900 per ounce. Same story, euphoria, new normal. Crash. 2025, gold at $4,000 plus. What changed? Same script, different year. Now, here's what nobody wants to admit. When everyone runs to the same safe haven at the same time, it stops being safe. Let's do a thought experiment. Imagine every airplane at an airport tries to take off at once. What's going to happen? Total chaos. Runways jammed. Nobody gets off the ground. Same thing with gold. Institutional buyers, hedge funds, regular folks, everybody is crowded in. When everyone is on one side of the trade, Who's left to buy? I call this the who's left effect. When Deutsche Bank, JP Morgan, Goldman, and a million retail investors all say gold is the only answer, that's usually the beginning of the end. And guess what's quietly happening? The so called smart money is already paring back their bets, reducing exposure, hedging their portfolios. You won't see them announce it on TV, but you can watch their actions in the data. Cut 2. Data visualization of ETF outflows, fund manager position reductions, central bank buying slowing. Let me tell you about a time I watched a market mania up close. In the early 2000s, I was watching the real estate bubble with a sense of dread. In Silicon Valley, houses went from $400,000 to $1.4 million in 3 years. Suddenly, every engineer I met was a part-time real estate speculator. They weren't building products. They weren't creating value. They were flipping houses. Here's something I learned the hard way. When an asset produces nothing but price gains and people only buy it because it went up, that's not investing. That's speculation. It always ends badly. A wise friend once told me, in a gold rush, sell shovels, not claims. Let me show you how this works with gold. Gold is the world's oldest fear trade. It's the original shiny object. Every time there's a crisis, or even just the rumor of one, gold spikes higher. But here's the trap. Just like in 1980, just like in 2011, by the time the crowd buys in, it's too late. Do you know the only people who got rich from the last gold rush? The sellers. The difference between buying a Google or an Apple and buying a piece of gold is simple. Productive assets create value while you sleep. Gold just sits there. I'll paint you a picture. Imagine all the gold ever mined stacked into a cube. That cube, at today's prices, is worth nearly $19 trillion. For that same $19 trillion, you could buy every acre of American farmland, $200 billion per year in crops. Own the top 20 U.S. companies, Coca-Cola, Apple, Microsoft, Oracle, just had to sneak that in, and more. And have money left over for a cup of coffee. So here's the question. Do you want to own a lump of metal or the companies, land, and brands that build the future? Let's break this down even more simply. Here's how you make money with a real business. You invest money. The business creates value. The profits are reinvested, compounding and growing your wealth year after year. Now, let's do the same with gold. You buy an ounce of gold. 10 years later, you still have 1 ounce of gold. No profits. No new gold magically appears. No value is created. So, who buys your gold for a higher price? Only someone willing to bet another person will pay even more. You're not investing. You're passing the hot potato. Think about the opportunity cost. Money in gold is money not in companies that are building, innovating, hiring, and paying dividends. Over time, that opportunity cost gets enormous. Small decisions compound. Now, I get it. This everyone's diving into gold feeling is powerful. The most dangerous words in investing are, this time is different. People justify it. De-dollarization, debt crisis, geopolitical disaster, China and Russia buying gold. Let's address these one by one. De-dollarization? Yes, there are attempts, but the dollar is still the world's reserve currency for a good reason. Even if it weakens, people flock to the next strongest asset, and history says that's usually not just gold. Debt crisis? Sure, debt is high. It's been high before, 1945, for example. The U.S. grew out of it. Gold didn't save anyone clutching it in the 1980s. Geopolitics? We've always had risk. Trade wars, saber rattling, new alliances. None of these changed the core math of what makes a good investment. China and Russia, they were huge gold buyers when gold was cheap. Now, as prices soar, even their buying is slowing. The World Gold Council's own numbers show that new buying is stalling at these high levels. Let me remind you, the big players buy low, and they start to sell when everyone else is rushing in. You've heard parabolic price action. Gold just keeps going up until it doesn't. So, what pops the bubble? Here are the triggers I'm watching. 1. A change in the narrative. Right now, fear is driving everything. But what happens if inflation keeps dropping? If geopolitics cool off? If the Fed signals victory? If any optimism returns? That fear premium evaporates overnight. 2. Central bank behavior changes. When your biggest and most steady buyer stops buying, or worse, starts selling, a 100-ton sale is enough to send shockwaves. Third, dollar strength. A rally in the dollar, say the US economy outperforms China and Europe, puts huge downward pressure on gold. 4. ETF outflows and margin calls. Gold ETFs have seen huge inflows, but most of those buyers are momentum driven. If gold dips 10 to 15%, you'll get forced selling. When leverage unwinds, prices collapse even faster. 5. Retail panic. When the small investors who bought because the price went up finally see losses, the panic becomes self-fulfilling. People want out, and there are no more buyers left. I've seen this script before. Dot-coms, housing, crypto, gold in 1980, gold in 2011. It's always the same. Let me break it down as simply as possible. Stage 1, the whisper. It doesn't start with a bang, it starts with a headline. Maybe inflation is lower than expected. Maybe the Fed pauses rate cuts, or tensions ease somewhere overseas. Suddenly, gold stops going up. Stage 2, the cascade. Leveraged buyers, hedge funds, traders get spooked. They dump positions. ETFs see outflows. The slide accelerates. Retail investors panic. I thought gold only went up. Suddenly, losses mount rapidly. Down 10%, down 20%, down 30%, as selling feeds on itself. Stage 3, the floor. Eventually, gold finds a bottom, usually way below what anyone expects. Sometimes it even overshoots to the downside. Historically, gold rarely trades below mining costs for long, but sentiment is so nasty by this point, nobody cares. Only then, after many years, does gold stabilize, and only for the most patient, least FOMO investors. Let's get concrete. If you'd put $10,000 into gold in 1990, you'd have about $75,000 today, before storage costs. Not bad, but $10,000 in the S&P 500 with dividends reinvested, about $300,000. $10,000 in Oracle or Apple? You'd be calling the shots from Maui. And here's the key. The only stretch where gold crushed everything else was 2008 to 2011, in the middle of a financial panic. Every other time, stocks, businesses, and productive assets did better. The simple truth, investing is about building wealth, not just avoiding fear. So, what's my game plan? Where will I actually put my money? Here's the checklist. This is where years of success in tech, and yes, plenty of mistakes, have led me. 1. Index funds and diversified stocks own slices of hundreds of businesses. Bet on human innovation, not headlines. 2. Best-in-class companies with wide moats. Apple, Microsoft, Oracle, Google. Companies with pricing power, recurring revenue, low debt, and global scale. Businesses that grow and adapt. 3. Short-term treasuries and cash. With interest rates high, these pay 4 to 5% risk-free. No drama, liquidity, flexibility to buy bargains when the next crash comes. 4. Real estate slash farmland. Actual productive assets that generate rent, grow crops, build communities. 5. Investing in yourself. Best ROI I've ever achieved has been learning new skills, coding, sales, management, leadership. Just as important as what I buy is what I avoid: gold and other non productive assets. Unless you're a central bank or you make jewelry, gold will never make you rich. It just won't. Crypto and Bitcoin. If you think gold is bad because it produces nothing, Bitcoin is worse. At least gold has a couple thousand years of trust and a few industrial uses. Crypto? It's rat poison squared. Gold mining stocks. These are even riskier than gold itself. When the price crashes, mining stocks drop twice as far. Long-dated bonds. In a world where interest rates might stay higher for longer, don't take duration risk. Let's say you ignore all this. You buy gold at $4,000 because everyone says it's going to $5,000. If you're right, you make 25%. Nothing to sneeze at, but hardly life-changing. If you're wrong, and history repeats, you could lose 40 to 50%. And all the while, you missed years of compounding returns from businesses, land, and innovation. Here's the lesson Wall Street doesn't want you to learn. The difference between following the crowd and thinking independently is the difference between surviving and thriving. So, if I were starting with $100,000 in 2026, here's what I do: 40% in index funds, S&P 500 or total market. 30% in individual world-class companies with pricing power. 20% in short-term treasuries cash for flexibility. 10% in top-tier real estate on farmland, if you've got the expertise, or else just put it into more index funds. Notice what's missing. Gold. Zero allocation. Let me close with something you might not hear from Silicon Valley much. Buying great businesses at reasonable prices and holding them for long periods works. Running towards every safe haven that gets hyped in the moment? That doesn't. Gold bugs will scream, "I'm a fool." You don't get it, Larry. This time is different. But every bubble in history, from dot-coms to housing to 2011 gold to crypto, looked like this time was different. Guess what? It never is. Let me give you one last trick. I call it the Ellison weighing machine. In the short run, markets are voting machines. Everyone votes for what's trending, what's moving, what's hyped. But in the long run, markets are weighing machines. They weigh the real value, the cash flows, the productivity of what you own. Gold produces nothing. Businesses produce value. Guess which side the market will reward in the end. Now, before you go, here's the plan. Ask yourself, will you be the one chasing the crowd or the one thinking independently when the trend reverses? Comment below. Are you holding gold? Are you holding stocks? What lessons have you learned the hard way? I read every comment. If you want my exclusive Ellison investing checklist for 2026, a simple one-page PDF to keep you rational when everyone else is losing their minds, drop a checklist in the comments, and I'll send the link. And if you found value here, hit subscribe, share this with a friend who's about to get FOMO'd into a gold ETF. And don't forget, the future belongs to those who think for themselves. Thanks for watching. Invest bravely, don't follow the crowd, and build something that matters. I'm Larry Ellison. See you in the next one.